On the evening of Saturday, March 21st, 2026, President Trump posted a message on Truth Social. He threatened to obliterate Iran's power plants if the Strait of Hormuz was not fully reopened within 48 hours. Crude oil futures immediately spiked. Brent crude climbed 1.69% at Sunday's open, hitting approximately $114 per barrel. West Texas Intermediate broke $100 for the first time since the early days of the conflict. Then 2 days later, according to a Financial Times investigation cited in Wikipedia's economic impact documentation for the Iran war, approximately $580 million in bets on falling oil prices were placed in futures markets. That positioning occurred approximately 15 minutes before Trump's March 23rd announcement. The announcement that postponed the strikes and sent oil tumbling more than 10% in a single session. 15 minutes. $580 million. Positioned to profit from a peace announcement before that announcement existed in public. This analysis is not making a legal claim about that trade. It is making an analytical observation. In a market where Monday outcomes are determined by Sunday night announcements, the question is not whether you're smart enough to trade this correctly. The question is whether you are honest enough to recognize which side of the information structure you're on. That $580 million position is not the central story here. It is the clearest single illustration of a structural reality that the mainstream consensus narrative has been obscuring for weeks. To understand why this moment is analytically different from the standard historical template, 4 structural conditions need to be examined in sequence. The first is the primary shock magnitude. The International Energy Agency has stated, in its own published language, that the Strait of Hormuz closure represents the largest supply disruption in the history of the global oil market. The current disruption removes more than 20 million barrels per day from normal flow. The 1973 Arab oil embargo cut global supply by approximately 4.5 million barrels per day, according to EIA historical data. The current disruption is more than 4 times larger in volume terms. The 1973 episode is the specific outlier in market history that produced a 44% S&P 500 decline and 6 years of lost returns. The current supply shock is larger than that outlier on a physical basis. West Texas Intermediate crude stood at $67 per barrel on February 27th, according to market data published by Financer.com. It hit $111 on March 8th, a 66% increase in 9 days. Brent briefly touched $119 at its peak before Trump's March 23rd announcement triggered a 1-day decline. Goldman Sachs, in its March 23rd published analysis, raised its Brent crude forecast to an average of $110 per barrel for March and April. Goldman also projected that if Hormuz flows remain at 5% of normal capacity for 10 weeks, Brent could approach or exceed the 2008 record of $140 per barrel. The second structural condition is cushion absence. Every major oil shock in the modern era has had absorbing factors that limited market damage. In 1990, when Iraq invaded Kuwait, the Federal Reserve had policy room to respond aggressively. The S&P 500's Shiller CAPE ratio in August 1990 stood at approximately 17. Valuations were not stretched to historic extremes. In 2026, 3 cushions are simultaneously absent. The Shiller CAPE ratio, the cyclically adjusted price-to-earnings measure that smooths a decade of earnings cycles, stood at 39.8 as of early March 2026, according to data published by Financer.com. That is the second highest reading in 150 years of market history. The only time it was higher was at the peak of the dot-com bubble in 2000 when it reached 44.19. Historically, when the Shiller CAPE has exceeded 39, markets have averaged negative 4% returns over 1 year and negative 20% over 2 years, according to Financer's March 2026 analysis, citing publicly available CAPE calculations. The Federal Reserve left interest rates unchanged at its March 18th meeting, as reported by multiple outlets. With oil prices elevated and inflation already above the 2% target, the Fed is not in a position to cut rates aggressively to cushion the economy the way it did in 1990 when it cut from 8% to 5.5%. Goldman Sachs strategist Dominic Wilson characterized the situation directly, describing the Federal Reserve as facing what he called a genuine stagflation dilemma, if the oil shock persists. And per the Motley Fool's March 29th reporting, Moody's recession probability model stood at 49% as of February 2026, before the full oil shock had registered in economic data. That model's historical track record, every time it has crossed 50% in back-tested analysis over 80 years, a recession followed within 12 months. No valuation cushion, no monetary policy cushion, near-threshold recession signal. The 3 absorbing factors present in 1990 are absent simultaneously in 2026. The third structural condition is what this analysis calls the lock effect, the mechanism the mainstream narrative consistently glosses over. As CNBC reported on March 13th, bond prices have fallen alongside stocks, with 10-year Treasury yields rising to 4.4% as investors price in fewer rate cuts and higher inflation simultaneously. In a normal shock, bonds rally when stocks fall, providing portfolio protection and allowing the Federal Reserve to cut rates into falling markets. When both bonds and stocks decline together, as they did in 2022 and are doing again now, there is no traditional safe haven absorbing the impact. The central bank faces a direct conflict. Cutting rates to fight recession would worsen oil-driven inflation, while holding rates to fight inflation accelerates the recession risk. That is the textbook definition of stagflation dynamics. It is not projected. It is currently visible in the simultaneous movement of oil prices, bond yields, and equity valuations in March 2026. The S&P 500 was down approximately 7% from its January peak as of late March, according to CNN Business reporting from March 26th. The Nasdaq entered correction territory, down more than 10% from its peak. By late March, according to CNN Business, the VIX, Wall Street's implied volatility measure, rose from the mid-teens to near 32 by early March before briefly pulling back. The fourth structural condition is what Marco Papic, geopolitical strategist at BCA Research, described in an analysis published by CNBC on March 28th. Papic estimated that the world has lost between 4.5 and 5 million barrels of oil per day from the war through roughly April 19th. After that date, his analysis projects that number approximately doubles, reaching 9 to 10 million barrels per day, as strategic petroleum reserve releases and IEA emergency measures approach the limits of their effectiveness. The IEA's 400 million barrel emergency release, the largest in its 50-year history, compensates for approximately 20 days of normal Hormuz flow. When those 20 days of buffer are consumed, no current policy tool replaces the missing supply short of physically reopening the strait. The April 6th diplomatic deadline and the April 19th supply cliff are separated by 13 days. If the April 6th deadline is extended again and the 13-day interval passes without a resolution, the physical shortage becomes structurally unmovable by any existing government tool. Goldman Sachs projects that scenario points directly toward Brent prices that could challenge or exceed the 2008 record. Two historical case studies define the analytical boundaries of this moment. The first is October 1973. The specific outlier in the historical data that the comfortable 6% average geopolitical drawdown obscures. On October 15, 1973, 4 days before OPEC formally announced the Arab oil embargo, the stock market was operating in what most analysts at the time described as an ordinary cyclical correction. The S&P 500 had been weakening on unrelated concerns. The oil embargo was not the beginning of the decline. It was the amplifier of a fragility that already existed in the valuation structure. The Federal Reserve in October 1973 was already tightening monetary policy to combat inflation. When oil-driven inflation accelerated, the Fed could not pivot without abandoning the inflation fight. The combination, supply shock, elevated valuations, locked monetary policy, produced a 44% market decline and 6 years of lost returns, according to Capital Economics and RBC data cited by CNBC in March 2026. According to RBC's analysis, the S&P 500 dropped 16.1% in 42 days after the Yom Kippur War began. The 1973 episode is categorized in historical databases as a geopolitical event, placing it in the same data set as the Gulf War, the Ukraine invasion, and dozens of other episodes where oil shocks were smaller, valuations were lower, and monetary policy had room to respond. Averaging 1973 with those events produces the 6% average drawdown figure that is arithmetically accurate and analytically misleading for 2026. The second case study is August 1990, the most reassuring comparison in the consensus toolkit. The S&P 500 fell roughly 15 to 16% following the Kuwait invasion and recovered fully within months. The mechanism of that recovery was the Federal Reserve's aggressive rate-cutting response, from 8% to 5.5% between late 1990 and the end of 1991. Remove that variable, which the current inflation environment does, and the 1990 episode looks dramatically different. The 15% drawdown and rapid recovery was not the result of market resilience to oil shocks in the abstract. It was the result of the Federal Reserve having the flexibility it does not have in 2026. Defiant Capital Group's March 26th analysis noted that 19 of 20 major geopolitical events since World War II saw the S&P 500 recover losses within an average of 4 weeks, citing RBC Research. The historical base rate for recovery is 95%, but 1973 is the 5% exception, and the structural conditions in 2026, second highest CAPE in history, locked monetary policy, largest supply disruption in recorded history approaching a supply cliff, match the 1973 structural profile with a precision the historical average was never designed to measure. The pattern of Sunday night announcements is the most operationally significant data point in this entire analysis, and it has received the least analytical attention. Trump's March 21st ultimatum was issued on a Saturday evening. His March 23rd reversal, the announcement that sent oil down more than 10% in a single session, came Monday morning before markets opened, with approximately 12 hours still remaining on his own deadline. His subsequent extension of the April 6th deadline was posted on a Thursday, also before markets opened. CNN's political analysis from March 23rd noted what it described as Trump's suspiciously market-timed announcements. The analysis characterized his March 23rd pause as having probably prevented what CNN described as another especially brutal Monday open. On March the 2nd, after the initial strikes on February 28th, the S&P 500 closed essentially flat, up 0.04% after recovering from a 1.2% intraday low, according to CNBC's live coverage from that session. Investors bought Nvidia and Microsoft aggressively. Software stocks rallied. The conventional read was market resilience confirmed. But between March the 2nd and the week of March 14th, the S&P 500 did not recover to new highs. It drifted steadily lower, hitting new 2026 lows as reported by CNBC during that period. The initial bounce was not recovery. It was a sentiment-driven reprieve inside a deteriorating trend. That is the documented fingerprint of 1973, not 1990. In 1973, multiple relief rallies occurred within the larger 44% decline. Each was interpreted at the time as evidence that the worst was over. The structural pressures, locked monetary policy, elevated valuations, sustained supply shock, were not resolved by any of those rallies. The April 6th deadline expires at 8 p.m. Eastern Time on a Monday. If that deadline passes without extension, the following trading session, Tuesday, April 7th, opens into an unresolved ultimatum. That is the calendar convergence point. Not because anyone scheduled a crisis, because the diplomatic calendar and the supply mathematics are converging on the same 2-week window. The $580 million futures position placed before Trump's March 23rd announcement, described in the Financial Times investigation, is relevant not because of what it implies about any individual actor. It is relevant because it illustrates that in a market where the binary event is a weekend announcement, the most consequential positioning happens before the weekend is over. The bull case for this situation is analytically serious and deserves direct engagement. First, the United States in 2026 is not dependent on Middle Eastern oil the way it was in 1973. The United States is currently the world's largest oil producer, confirmed by EIA data. The spread between Brent crude and WTI exceeded $14 per barrel on March 23rd, according to CNBC's reporting from that day. That spread is the data signature of American relative insulation. The rest of the world absorbs more damage than American domestic consumers do. Second, the 95% historical recovery rate is real data, not a fabrication. 19 of 20 geopolitical events since World War II saw the S&P 500 recover within roughly 4 weeks. Positioning as if 2026 is 1973 means betting against a 95% historical frequency. Third, Trump has consistently extended or reversed his most extreme positions before they generate irreversible consequences. Each Sunday night ultimatum has so far been followed by a reprieve. Diplomatic channels through Pakistan and other intermediaries remain active. A deal that reopens the strait would be simultaneously anti-inflationary and pro-growth, the exact reversal of the stagflation scenario. These three arguments are confirmed data, not wishful thinking. The single data point that the bull case cannot fully absorb is the April 19th supply cliff. BCA Research's Marco Papic, as reported by CNBC on March 28th, projects that the physical supply loss doubles around that date regardless of diplomatic developments, because the IEA emergency releases and strategic petroleum reserve drawdowns are calendar limited, not diplomatically adjustable. The bull case requires a deal before the strategic buffer exhausts. The April 6th deadline and April 19th supply cliff leave a 13-day window. If that window closes without a resolution, no announcement postpones the physical mathematics. 4 priority actions follow from the structural data pattern. The first is understanding the difference between what you own and what is actually liquid in a volatile market. In March 2020, as Banking Exchange reported, off-the-run Treasury securities, among the most theoretically liquid instruments in existence, became effectively unsellable for several hours during peak volatility. Positions that appear liquid on a calm day may not be liquid during a Monday open following a weekend escalation. The time to understand your exit options is before the session opens, not after. The second is tracking 3 specific calendar dates with direct market implications. April 6th at 8 p.m. Eastern, Trump's current deadline against Iran's power plants expires. The outcome of that date will directly determine Tuesday, April 7th's opening conditions. Mid-April, specifically the window around April 15th to 19th, the period when BCA research projects' global supply loss doubles and IEA buffer releases approach their effective limits. Any Federal Reserve communication signaling a shift in its inflation versus growth calculus, if the Fed begins acknowledging that recession prevention may need to take priority over inflation fighting, that represents a regime change in the lock dynamic. The third is watching Brent crude's near-term forward curve, published daily by futures markets. When the spread between spot prices and one-month forward prices steepens, when oil for immediate delivery becomes significantly more expensive than oil for delivery in 30 days, that is the signal that the physical shortage is arriving ahead of projections. Goldman Sachs identified this condition as the precursor to their worst-case oil price scenario in their March 23rd analysis. The fourth is distinguishing between volatility and repricing. The current drawdown of approximately 7% from the January peak as of late March per CNN Business is not yet at levels that historically represent maximum pessimism in a structural repricing. The relief rallies within the current trend are pattern consistent with the documented 1973 episode, where multiple bounces occurred inside a larger 11-month downward structure. Each bounce was interpreted as recovery. None was.